Hello, and welcome to Moving Iron Podcast Markets with Shawn Hackett. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. If you're looking to accessorize your desk even more than the pair of Axon mouse pads you got last week, by God, you can get a desk pad this week. All right. So if you want one of those, go to marketing@axontire.com and you will have a soft layer of metric conversions between you and the hard part of your desk. So I don't know what you could ask for, Shawn. That feels like to me that's a winner.
I was thinking moving iron pajamas, but that's just me,
Maybe a onesie, you know what I mean? Just really bring it back. You know what I'm saying? But if you're interested in getting a Axon desk pad, go to marketing@axontire.com and they will send you that. Just give them all your information and they will give that over to you. So at marketing@axontire.com. Valley Transport's been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs at Valley Transportation. Our goal is to help you reach yours. And no matter how you buy your ag equipment from a dealer, auction, or a private party, AgDirect can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com. Tractor Zoom has access to over $20 billion in heavy equipment data sales. Tractor Zoom's Iron Comps is the industry's trusted solution for transparent equipment values and auctionable pricing insights. This podcast is brought to you by Anvil AppWorks, the Dealer Connect CRMI app with integrated inventory management is an affordable Salesforce-based solution for your dealership. Create connected customer experiences and transform. Don't firm it, just transform it. And you can transform how you work. Shawn is with Hackett Financial out of Boca Raton, Florida. He's nice enough to come on and talk about what's going on in the marketplace. Shawn, how you doing this morning?
I'm doing really good, Casey. Really good.
Well, it's good to be back in the swing of our normal schedule here. Apologize to all the people out there. Had to take a couple weeks off, had Moving Iron Summit stuff to get ready and everything else. So this last 3 weeks ahead of that time frame is a pretty busy time for my wife and I. So got to bang through that. But Shawn's back here, and let's spend a little time talking about what we saw come out of the Pro Farmer Tour. You have the Farmer Business Network information, and Michael, what's his last name? Michael
Cardinier.
There you go, that guy. They all came back in with a pretty similar estimation of what corn and soybeans would look like. Pro Farmer tagged it at 168.1 bushels an acre on corn and 51.7 bushels an acre on soybeans. Farmers Business Network was like 70 and 50, and Cordione is right around 70, and his soybean number is, I can get back over here real quick. Looks like his soybean number is about 50.5. So they're all in the same stratosphere anyway. But looking at that, and you start looking at what's going on with carryout and everything else, we're in a very tight spot going into another one of these years. So, I mean, as you look at the corn market and you're looking at the soybean market and you're starting to see that weather premium start getting built back in. We've seen about 4 or 5 days here, very strong run up in price. Obviously, there'll be some corrections along the ways and profit taking and those kind of things that are going to mess with price a little bit. But overall, the argument, I guess, can start being made of what's the 23 price need to be to get people to plant X number of acres. So I guess what's your thoughts there, Shawn?
Yeah, I mean, it's just, obviously the market never knows for sure what's going to happen with weather, but they have to factor in the, a worst case scenario. What if South America has another short crop? I mean, let's take a step back. I know, a decade ago, we warned about the coming along of a grand solar cycle minimum that would kick in around 2019 that would lead to an expansion of weather volatility for 20 or 30 years. And since 2019, we've seen dramatic increases in weather volatility. Just this year, just take a look at the weather volatility we've seen, from an historic drought in Europe to an historic drought in southern China, historic flooding in Pakistan, historic flooding in places like central India. So we're seeing these extreme, very, very cold, long winter here in the U.S. we're getting more and more of these extreme weather patterns that make it very, very difficult to grow crops consistently. Either you hurt the crop in the beginning, you hurt the crop in the middle, or you hurt the crop in the end. But it seems like you just can't have a season where you have a good runway through that allows you to have that bin buster crop that was pretty commonplace, during the more normal weather volatility years.
Mm-hmm.
And as you know, this cycle we think is going to get worse. I mean, we're going to get more volatile. The Gleisberg cycles we talked about before is coming up here in 24, 25. So nothing about the weather is going to ease back on the ability to grow food. And so I think this is a great example. We had a very difficult planting season. We had a good start. The middle was all right, and now we're having kind of a bifurcated finish, and the crops are okay, but not great. But in this environment, Casey, that's not good enough, right? That's not good enough. Just take a look at corn crop in Brazil. Supposed to be this record crop. Everyone thought it was a record crop. The exports out of Brazil are not showing up. They're not showing up. They're not showing up. And that means they don't have the crop everybody thought. Brazil does not hold crop back. They always sell if they have it. And so now everyone's downgrading the corn crop from last year. And not that it's a bad crop, but compared to what everyone thought it was, now it's just going to be good, but not great. But in an environment where we have no ending stocks, Casey, we need great, not good. Right. Now, what happens if we get bad? Not, okay, we've had okay crops and we're struggling to keep supplies going. If we have a bad, like if we have this Gleisberg cycle in 24, 25, and US comes offline with a 2012 style production shortfall, then we enter a completely different situation than what we're in. We're in right now is we have just enough. We enter something like that, then we don't have enough. And there's a very different pricing structure between we have just enough to we don't have enough. And what that might mean geopolitically, what that might mean in terms of currencies, what that might mean in terms of government policy, protectionism, stockpiling. I mean, there's a lot of things that go into what that means when food actually runs out for certain countries who don't have the ability to grow enough of their own food. The United States is fortunate that even in a scenario like a Gleisberg cycle, we would still have enough food to produce for ourselves, albeit we'd have to pay a much higher price for it. Other countries couldn't get the food for any price. And that's right. where I think we might be heading into if we have a big country come offline, like I think could happen in 24, 25.
So the question I have, and I'm thinking about this quite a bit. So the Gleisberg cycle, like you're talking about, 24, 25, let's say next year comes around and it's different than what you say it's going to be. It's not, we don't have the early frost and a late frost type of thing. And it's just a typical winter and things are good. We start planting, April 15th, like we everywhere does, we're throwing and going, getting after it, have a great growing season, have a bumper crop, things go out of control. And then the Gleisberg cycle 24, 25 happens and we have this epic drought come through. Now, North America going into a La Nina cycle or an El Nino cycle where that is more favorable towards those growing cycles. But if you have one just out of control, just amazing year, right? And then you follow that up with a year or two of a pretty epic drought. I mean, you're even worse off now than you started, correct?
Well, I mean, we are anticipating much better production in the next crop cycle. We've been clear about this from prior, and I want to be very, very clear that we actually think we're going to be able to get ahead of the curve here a little bit in the next crop cycle. South America and the U.S., I believe, are going to have some very, very good crops that will add some buffer. Not the whole thing, but add some buffer to what's coming. But the crop shortfalls we're talking about in 24, 25, especially in the U.S., would be so substantial. That what one good year isn't going to save it. You know what I'm saying? I mean, we're not going to get to 3 billion bushels of corn. I guess is what I'm getting at. You know, what we had back in 2020 at 3.5 billion bushels of corn. We're not getting back to 3.5 billion bushels of corn. If we have a really, really good year coming up, maybe we get back to, 1.8, maybe 2 billion bushels max, right? But that's not enough. I mean, that's not enough to handle a crop shortfall. That's not enough, to handle half a crop shortfall. So, but it would allow a brief window of opportunity for countries who don't have enough to get some. Meaning, if I'm thinking this through, if Sri Lanka or Indonesia or some country or China, knows that they don't have enough food and they need to, and they think Shawn's correct about what's going to happen here in 24, 25, then I would be a very substantial stockpile when they're getting as good. Build up those reserves so when the gavel falls down in 2025, you have enough food to get through it because you prepared in advance of this potential risk factor that's coming. My hope is that enough countries or enough people get that message and can take positive action in the next 12 months when there is going to be some supply, there is going to be some lower prices, there is going to be some bearishness in the market to get themselves in a position where they can actually get through a period of food crisis. Because if they do not, then they're going to fall by the way of a Sri Lanka situation where the food is out, the people are angry, and they're looking for blood. Mm-hmm. And we've seen this throughout history that dynasties and governments and countries fall repeatedly when the food runs out and the population wonders, how did this happen?
Right. Yep. Yeah. A lot of stuff to think about there. All right. So speaking of harvest and stuff going on, so Ukraine had another 6 ships get out of the Black Sea ports today, and they're bringing so it's a total of 61 vessels that have left there. So now you've got 2 things going on in Ukraine right now and Russia, both that's very, very important and very timely, is that you've got, especially in Ukraine, you have a big, vast number of men and women that are fighting the war in Russia, but they're also trying to harvest their crop right now. And the same thing is going on in Russia too. So you've got this kind of, bifurcation, I guess, of what they're supposed to be doing and how they're handling those things. Looking at that situation, especially with a mounting, assault coming that Zelensky keeps talking about with Ukraine. The weather window, I don't know how many people have been to Ukraine, but winter in Ukraine is no joke. Right. It's cold and it snows, and it's cold and it snows. So it does those 2 things pretty well during that time frame. So they have a short window to do 2 things: get their harvest out and also have this assault. So, and same with Russia. Russia's got the exact same issue as well. Looking at that situation, Shawn, I guess, how positive are you that even though they do have these massive bumper crops over there right now, how good do you feel about those actually getting to market?
I think it really comes down to how Europe's going to handle things this winter. I mean, they're going into a catastrophic energy crisis.
Yes, they are. If
they don't get natural gas coming in from Russia. Yep. And I mean, like, they're going to shut down. It's going to be like COVID all over again. Europe's going to shut down again.
Yeah.
Because no one can operate any plant without energy. I mean, it just almost seems like a lockdown situation if they don't. I just feel the leaders of Europe can't go into this winter without doing something to offer an olive branch to Russia, to do something to provide a conduit for some new normal to allow them to get through this winter. And of course, remember this drought that they've had in terms of catastrophic low corn feed, animal situation devastated over there because of the drought. I mean, their food situation is in really bad shape. So I just think when you're looking at low food, low energy, wintertime coming, I just can't imagine that they can go into that and say, well, we're just going to shut down and I think they're going to have to do something. I mean, this is just me speculating. Like I said, when you're talking geopolitics, it's hard to know if and when what will happen. But I just can't imagine that Europe is going to go into the winter without doing something to open up food supplies and energy supplies and give them a a window, a conduit to get through this rough patch. I just think they have to look at the needs of the many are going to have to outweigh the needs of the few. I think at some point they're going to have to do that. And so ultimately, I think that's what will happen. And how it comes about, and maybe this conduit opening between the broker deal between Turkey and maybe this is the early way that this whole agreement that's still underway that might actually include Europe at some point. Maybe this is all part of that plan of how Europe finds a way to save face and do what they actually need to do for their people, and so they don't starve to death and freeze to death.
Yeah. So that was my next topic was just energy as a whole. Looking at what you see happening with oil. You had a good run up yesterday. You look at natural gas; it just continues to climb across the board. We talked about fertilizer. We had a special where we did just fertilizer here. I just released that over the weekend, so that's out there. But I guess looking at those energy as we start heading into harvest, and a lot of guys have pre-contracted their stuff that they need going in that. But you start looking at diesel costs still above, $4 a gallon. Off-road diesel still around anywhere between $3.80 and $4.50 a gallon, depending on where you're at. You start looking at natural gas and $8 and $9 natural gas, and you get over into Europe, it's whatever, 30 or 40 bucks, a unit over there. And you start looking at fertilizer, and that's going to start playing out in those scenarios. Looking at the energy situation right now, Shawn, what are your thoughts there, and how do you think that's going to impact what people decide to do going into 23 as far as deciding what crops are going to get what?
Well, where would crude oil prices be? Where would diesel prices be? Where would gasoline prices be if we weren't dumping strategic petroleum reserves onto the market?
Yeah.
Where would we be? I'm not smart enough to know what the price would be. It would be substantially higher.
Yeah. It'd be more than what it is now. Yeah.
And we won't continue to sell that. My belief is that as soon as the elections are over, that will stop.
Right.
Almost immediately, I believe. So if that's correct, that if that artificial supply comes offline, or either because we stop it or we just sold as much as we can sell, is there spare capacity, crude oil production capacity in the U.S.? Is there spare capacity in Middle East to dramatically increase production over the next 12 months? The answer is no, there's not. In fact, repeatedly, Saudi Arabia has missed their production quota targets month after month after month after month. And there's only one reason why they missed the quotas, because they don't have the spare capacity that they claim they have.
Mm-hmm.
They're not going to come out and tell everybody, because their power is, we have all this oil, we could dump it on the market at any moment. I actually believe that's not the case anymore. I believe they actually are at max spare capacity. That doesn't mean they can't invest. They can't, but that takes a long time, Casey. That's years. Right. And yeah, we can incrementally grow production here a little bit, but we told everyone for the last 3 years, stop. And everyone in the government is telling you stop. And so now we're telling you, please do it now. And it's just, I don't see anything going on with the spare capacity in the industry that's going to allow dramatic increases in natural gas or crude oil globally anytime soon. And so if we do remove that strategic petroleum reserve pressure, unless we go into a complete depression from a demand standpoint, energy prices are going to stay high and go considerably higher over the next 12 months. Until such time that either, we get that spare capacity going again, or the high energy prices does put us into a depression or a deep recession where demand just falls off and the price comes down. Either way, I definitely would want to make sure my energy needs are protected to the upside. If you're a cash buyer of crude, if you're a cash buyer of propane, if you're a cash buyer of natural gas, LNG. I certainly would want to make sure my upside price risks are handled, because I think this period of correction that we've seen in crude oil, remember we were 125, now we're in the low 90s. I mean, that's one heck of a correction. I think this is an opportunity in the crude oil area. And we might get that opportunity in natural gas as we go into the next couple of months where demand tends to fall down a little bit because of seasonality. There might be an opportunity to do something with natural gas. So I guess bottom line is, to me, upside price risks are where I'm worried versus the downside here.
Right on. All right, let's talk about the protein markets real quick. Cash hogs continue to slide. You see some weakness there. These kind of keep not big slides, but you're just seeing a steady erosion of the price. And cattle prices right now are doing the same thing. You see some averages week over week that are showing some either steady to weakness type of approach there. So obviously we're outside of that seasonality where we're going to see a more demand. But that being said, hog herds and cattle herds both are at all-time low. So I guess looking at this, Shawn, what are your thoughts there?
Well, we always have to separate the short term from the longer term. The short term picture is when the feed price goes up, cattle prices come down. It's just that simple. We've had corn is $1.20 off the lows from late July, $1.20. That pressures cattle prices. Seasonally, cattle prices like to correct in the month of September. So we're at the wrong time of the year for the market to be strong. Longer term, though, next year, beef production in the U.S. is expected to fall between 1.6 and 1.8 billion pounds, or 7% reduction in U.S. beef supplies for next season due to lower animal feeding units, due to the herd liquidation we've had in the last several years. So the question becomes, can the U.S. economy be so bad that a 7% decline in beef prices will not allow for a substantial increase in the cattle price or the demand for cattle? Our guess is that the U.S. economy will be good enough that a 7% decline in beef production, by the way, unprecedented, that kind of year-over-year decline, unprecedented. Our belief is that kind of decline and is going to lead to a significant increase in the demand for less animals coming to the market as herd rebuilding takes over. And so beyond the short-term correction that we've been warning about to our customers in our reports, the intermediate term picture still looks very, very bright to us. And so we still are very favorable towards the cattle price from, let's say fourth quarter, especially late fourth quarter onward. Now, hog price is an international market, whereas the cattle price is pretty much a local market, right? So the hog price in China skyrocketing. It's actually made new highs here just recently. We've talked about this before, that they had this massive secondary liquidation of hogs due to ASF and also just terrible economics. It flooded the market with pork and they had a crash. And we lost demand from China. Now their hog price is going through the roof, meaning the hog liquidation is over. And that means that the herd rebuilding is back. And that means that pork production is going to crash at a time that China needs maximum pork supplies by the end of the year to satisfy the demand during their January, February holiday season every year. And so it's our anticipation that they are going to be coming in and being very large buyers of U.S. pork as we move into the fourth quarter. And given the mini crash we've seen in the hog price, if you look at like the February price, we were in the low 90s and we came into the low mid 80s. We think that the hog price is already more than factored in any short-term demand issues and increased weights that we've been seeing. And now we're going to need to price in this strong demand coming back from China that we think is going to be a good tailwind for the market heading into the end of the year. So we think now that this correction in hogs is over, or it's already occurred, we're pretty comfortable with a better price heading into the end of the year. So we think cash buyers of hogs, this is a good spot to be, getting some of that getting some of that bought in and protecting your upside price risks. So we're, I think the cattle price has lower to go. I think the hog price has already corrected and factored most of it in. So
right on. Okay. Well, good stuff as usual, Shawn. Folks want to reach out to you and get more information about what you're doing at Hackett Financial. What's the best way to do that?
Our website is Hackett, Hackett, advisors.com. Lots of information about our weather algorithm, our smart money capital algorithm, and just how we go about trying to price forecast markets so that everyone in the agricultural space can bring some more money home. So
right on, man. I am Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram at Moving Iron LLC, LinkedIn at Moving Iron Podcast, and see the video version of this podcast at the Moving Iron Podcast YouTube channel, which is just the Moving Iron Podcast YouTube channel. I really went out on a limb with that creative ability on that one, Shawn. But check that out if you're interested in seeing that stuff. Go to MovingIronLLC.com for everything Moving Iron related. Got a couple blog posts I need to get posted up there so you can see some stuff there, and all the information on the Moving Iron Summit will be there as well too. That's sold out, so if you just want to see the agenda, you can check that out. So other than that, we'll catch you next year. But Shawn's going to be there. He's going to give his presentation about a lot of stuff that you hear in this podcast. Weather, he sees happening, the weather, how that's going to affect the markets and those kind of things. So Shawn, looking forward to that.
I really am. It's our, as I said, our presentation is dramatically changed because of the shift from La Nina to El Nino. So it's going to be a lot of new stuff, totally virgin territory for anyone that's listened to us speak over the last couple of years when we were in more of a La Nina orientation. So I think it's going to be a really good presentation, and I think it's going to bring a lot of new information to light about how weather's going to change, where it's going to change for the better, and where it's going to change for the worse.
Right on. Okay. Well, Shawn, I appreciate you being on the podcast, man.
Always a pleasure, Casey, and look forward to doing it next week. So.
Me too. All right. I'm Casey Seymour with Shawn Hackett. Let's go smart, folks. Out.
Moving iron in the 21st century.